Hi everyone. I'm going to give problem 12-7A a try and see if I can demo this for you. It's one of the more challenging cash flow problems, and hopefully walking through this may help you with a problem that's like it on the final exam. Okay, what you're looking at here is a screenshot of P12-7A from the ebook. We have some comparative balance sheets in front of us, and there's some other extra information below. There's an income statement for the year ended 2004 and some other data. All I'm going to work through is Part A, which is prepare a statement of cash flows using the indirect method. Okay, let's put this back up, and I'm going to flip over to Excel. I'm going to use Excel to solve this problem. Right about there is where we want to be. What I have here is the start of the problem with no information completed, and I'm going to go back and forth and solve this. The first thing that I would do in working with a cash flow statement is I would look to net income. Since we're going to work our way from top to bottom, we see that net income is $41,000, so why don't we fill that in? And you'll see that I've already formatted this for us to save us some time. Next, we need to add back adjustments to reconcile net income to net cash provided by operating activities. And the first one that comes to mind, in my mind, is depreciation. We should be able to get that right from the P&L, so let me look on down and see if we've got depreciation. There it is, Note 3, $8,000 is in the selling expense category. So they told us that depreciation for this company only existed in the selling expense. Little simplification, but that's okay. Next, what I would want to do is walk through the various current accounts to see how they've changed for the period. So I'm going to go back up to the balance sheet on the comparative balance sheet on 12-7. Let's slide this over so we can see everything. And we see that accounts receivable went from $14,000 in 2003 to $28,000 in 2004. Maybe I should change this to a pointing tool. That's okay. We'll live with it as it is. A 14 up to 28,000 is a $14,000 increase, and as you know, increases in current assets result in a decrease in the adjustment from net income to net cash provided by operating activities. So I'm going to go ahead and label this as increase in accounts receivable, if I can type it, and I'm going to show that as a negative $14,000. The next item I want to look at would be inventory, and on inventory we see that we went from $25,000 to $38,000. Again, it's a current asset, so an increase represents a decrease in cash if we are adjusting from net income to net cash provided by operating activities. So we need to show that $13,000 decrease, and that would be increase in inventory. Okay, now let's take a look at our next current item, which is accounts payable. Accounts payable goes from $43,000 at the end of 2003 to $31,000. That is a drop of $12,000. If accounts payable decreased, it has the opposite effect of a current asset. We would like to see our liabilities increase. That would reflect a positive adjustment on cash. But since we have a decrease, again, we have a negative adjustment of $12,000. Let's put that negative $12,000 in, and we would label that as decrease accounts payable. Okay, if we look back over to our balance sheet, our comparative balance sheet, the next item we have to look at in the current assets section would be income taxes payable, and here we've gone from $20,000 up to $26,000. Since income taxes have increased, a liability has increased. That means we've used less cash if we're reconciling from net cash to net cash provided by operating activities. So here we want to show that $6,000 increase and label it as increase in income taxes payable. Okay, that gives us our total net cash. I'm going to just create a sum here to come up with all of our adjustments to reconcile net income to net cash. And as a result, we've now come up with the amount for net cash provided by operating activities. Now let's take a look at some of the other items we need to consider. Dividends of $36,000 were declared and paid. Okay, if we're declaring and paying dividends, that needs to be reflected in the financial activities area. Why don't we label that payment of cash dividends? And again, you don't have to get the words perfect, word for word correct. Just give it your best shot. That will have a negative effect. Jumping back, what's our next statement? During the year, we had equipment was sold for $10,000. It cost $15,000, and originally had a book value of $10,000 at the time. So we had book value sold for the exact amount of cash that we received. That's telling us that there's no gain or loss. If there was a gain or loss, we would need to adjust the gain or loss here and show the gross amount of sale in our investing activities. I'm going to go back so we can follow that. But since this sale was equal to the book amount, there will be no adjustment in the adjustment to reconcile net cash to net cash provided by operating activities, the first part of our cash flow statement. But we do need to reflect the sale of equipment as a cash flow from investing activity. So I'm going to call that sale of equipment. And we'll show that up. I've got that in the wrong column here, the way I pre-formatted this. Now let's look at our next item. We've taken care of number 3. All sales and purchases on our account. Yes, I've assumed that to be the case. Which makes looking at receivables and payables very easy to do. And we've had an additional equipment purchase of $7,000, and they're giving you the information that it was paid for in cash. So here we have another cash flow from investing activity. We have the purchase of equipment. And normally if they give you a purchase and a sale, separate data, you wouldn't combine them. You would show them separately. As a result, we've now calculated our cash flow from investing activities given the information we have. It's an increase of $3,000. Let's take one more look at what else we have in here. Okay, we've looked at all of the accounts, and we've actually reconciled all of them, making sure that our adjustments equal the net changes. And I realize I'm sort of doing that in my head and not showing you how to reconcile dollar for dollar, but given the amount of time that this takes, I'm gonna gloss over that a little bit. One exception is bonds payable. We haven't looked at that account, and we've gone from $10,000 to $20,000. So since there's no other information provided about bonds that were retired, we can assume that there was an issuance of bonds of $10,000. I'm going to call it issuance of bonds. You could call it bond issuance. Okay. One of the beauties of the cash flow statement is if you've done it correctly, your cash will tie out. I believe at this point we've completed all of the information that we have does cash equal $26,000 at the end of the period? Go back and look at the balance sheet, and sure enough, we've now reconciled the $33,000 to the $26,000. If you look at all the changes we've made, we've come up with a reason for what happened in every one of these accounts. $8,000 swing here. The swing in accumulated depreciation was affected by depreciation as well as a sale of equipment that had book value. And we've reconciled all other items. We've reconciled common stock, there was no change, and the change in retained earnings was the result of cash dividends and income. I think that about wraps it up. That is the problem. Let me shrink it so you can see it here on your screen. Maybe we can see it all here. Up. A little bit hard to show. If I slide this down, perhaps we can see it. Okay, everyone. Thank you. I hope you found this demo helpful as well. Bye now.